Results day, 20 past 6 in the morning. The chief executive of an adhesives company walks her own lab, watching a machine tear glued metal apart. Every joint fails in the metal before it fails in the glue. The result you want. The glue held. The glue always held. At 7, the annual results went out. More cash than ever, less debt, dividend held for the 22nd year. By the close, the shares had fallen 7%. Within a week, they had halved from their peak. To the penny. Welcome to Owner's Lens, the show where we read businesses the way owners read them, not the way screens do. The company you just watched, Harrow & Vail, is fictional. We built it. 3 plants, 96 million shares, founded 1934. Precisely so we could show you its complete books, and so nothing here can ever be mistaken for a tip on a real share. But it is assembled honestly from the anatomy of real businesses, and what happens to it has happened over and over to real companies. Today, the first and most important idea in the whole craft. Every listed company has 2 prices, and only one of them is on the screen. Here is the halving, and it is worth walking it seller by seller. In September, the company dropped out of the index, and every fund that tracks that index sold the same week, contractually forbidden from having a view at all. In October, one segment's volumes fell 9%, 2 brokers cut, and the momentum machines, which sell whatever is falling because it is falling, joined the queue. In January, a family trust sold 6% of the company to pay an inheritance tax bill that had been with the lawyers for a year. The headline said insiders were selling. And in February came the results you just watched. A decent year, read in a poor light. 4 waves of selling. Not one of them was a judgment that the business was worth half as much. 3 of the 4 sellers weren't even in the business of making such judgments. That is what the price is set at the margin means. Assertions about mood are cheap, so do the arithmetic. It takes 10 minutes and it separates business problems from mood problems. Any share price is exactly 2 things multiplied together: what the business earns per share and the multiple the market will pay for those earnings. Across the halving, Harrow & Vail's owner earnings per share rose 12%. The dividend was held. Debt fell. The entire move, more than the entire move, was the multiple, from 25 times earnings down to 11. Same plants, same customers, who would each need up to 30 months to qualify a replacement glue. The only thing that got repriced was the willingness to own it. But give the mood its due, because the discipline is not the market is always wrong. Volumes really did fall in one segment. What the market did is what it always does. It took a direction of travel and priced it as a destination. Sometimes that's right. Some falling knives are falling for reasons that stay true. Here, the evidence ran the other way. Customers accepting price rises, the medical segment growing 11%, debt falling. A company being structurally destroyed does not do those things. Benjamin Graham gave the quote a personality. Mr. Market, your business partner, who arrives every day and names a price, some mornings euphoric, some mornings in despair, at which he'll buy your half or sell you his. It's usually taught as a fable about the market's madness. That undersells it. Used properly, it is a tool with 3 operating rules. 1. His price is information about him. Read a multiple the way a doctor reads a temperature. 25 times earnings means the crowd expects serenity. 11 times means it expects decay. Facts worth knowing. Neither is evidence about adhesives. 2. He is a counterparty, never a consultant. The shares are down 40%. Something must be wrong. Is a man taking business advice from his most emotional acquaintance. And the shares keep rising. It must be wonderful, is exactly the same sentence. The moment the price becomes your evidence, he owns you. 3. His offer is an option, not an order. You are never obliged to act, and the option never expires. The index fund must sell. The trust must pay its tax. The private owner who can simply decline is holding the only structural advantage in markets that cannot be arbitraged away. Patience is not a temperament lottery. It is a position. One more way to read it, and it turns the gap into a force. Flip the multiple upside down. Ask what annual cash return the business generates on today's price. At the peak, buyers were accepting a 4% cash yield from an industrial company, while the government bond paid 4.2, guaranteed. That is not analysis. It is enthusiasm. At the trough, the same business yielded 9% against a gilt at 4.5, double the risk-free rate, from earnings that were growing. And cash yields are why value eventually asserts itself. A gap that wide pays you to wait, lets every retained pound work twice as hard, and invites the company's own directors, and anyone who can read accounts, to close it. None of that arrives on a schedule. The point is mechanical, not prophetic. A large gap between price and cash recruits its own closers. A mood never has to. And the discipline is strictly symmetrical, because the upward edge never feels like a warning. The buyers at the peak had watched the price nearly double while owner earnings grew a quarter. Most of what they paid for was multiple, and the climb itself had come to feel like information. It always does. A share that is halved is not thereby cheap. A share that is doubled is not thereby proven. The move tells you nothing until you set it against the cash. And when a business you own is quoted at half its value, something real does happen. But it happens to your future, not your present. Same earnings, same dividend. What changed is the terms on offer for the years ahead. At the trough, a pound reinvested bought twice the stream of annual cash it bought at the peak. For an owner still accumulating, the halving was the sale, at the shop they already knew. Reading that sentence costs nothing. Acting on it on a red afternoon is temperament. The arithmetic comes first, because courage without a number underneath it is only stubbornness. This episode is Chapter 1 of The Owner's Mind, our book. The full chapter, with Harrow and Vale's complete accounts, is in the Academy at agenticsovereigncapital.com. Everything you heard is education, not investment advice. The company is fictional, and nothing here is a recommendation. The quote is the mood. The value is the business. A new episode lands every week. Follow so it finds you. We'll read you another page soon.